Welcome to QAV Australia, Tony. Episode 847. This is the 25th of November, 2025. 25/11/25 today, Tony. How you doing? What's good?
Good. Weather's good at the moment. It's fined up all of a sudden. It's gone from like 12 degrees to 22, 23 in like 24 hours.
Oh, that sounds lovely.
Played golf yesterday evening, but unfortunately smashed my driver. Don't know how. It just hit a good shot and the head just kept on going. So that's my only tale of woe. It was a good round otherwise.
Smashed your driver.
Yep. Shaft cracked.
Who was that golf company we were talking about on the other show the other day? Callaway, yes. Was it a Callaway?
It wasn't, no. It was a Ping.
Okay. Did it go ping when it broke?
No, it went snap and it just kept on going.
You see this machine? It goes ping.
Well, that's how Ping got its name. The putters used to do that when you hit the ball.
They went ping?
Yeah.
Wow, I've got to love the marketing person there.
Yeah. What's his name? Carsten Storens, I think his name was, or something like that. Redesigned the putter.
This one goes ping.
Redesigned the putter in his garage. And the first one he put out there used to have like a hollow sound to it, so it would go ping when you hit it. And he built a whole brand around it.
Clever. Well, first question off the cuff today, Tony. Able and honest, I wanted to ask you about. I had this idea the other day. I went into Gemini, Google's AI app. They've got a new version, which is the state of the art now. And I said to it, let's say I wanted to build a value investing system from scratch, built along the lines of Benjamin Graham and Buffett and Munger. Let's assume I have access to fundamental data of stocks in Australia. What should I be looking for? What are the metrics I should track? How should I score it? Want to stack rank it? Seeing if it would come up with some new ideas. It didn't, but it did have this one idea that I went, things that make you go, ooh, ooh, ooh. Remember that? 90s, early 90s?
Yep.
Okay. Able and honest. It called it the Able and Honest test. Read the annual report. Does the CEO admit mistakes or do they spin bad news? Look for adjusted EBITDA excluding real costs. And then he said, it quoted Munger. It said it was one of Munger's ideas, and I couldn't find Munger actually using that term, so I pushed back and it said, yeah, it wasn't Munger, it was Buffett. In his 2019 letter to shareholders, Buffett wrote, "We constantly seek to buy new businesses that meet three criteria. First, they must earn good returns on the net tangible capital required in their operation. Second, they must be run by able and honest managers. Finally, they must be available at a sensible price." I was like, Warren Buffett just condensed his investment philosophy down to three simple ideas. Are they making money? Are they run by honest people? And can you get them at a decent price? I always say, like, whenever I have to explain QAV, it's like we look for companies that are making money that we can get at a discount to their intrinsic value. But that's better. Available at a sensible price. I like that. And so I started to wonder, and I asked it, well, how would you actually measure that? Like, how would we do that in an objective way? How would we work out, like, is there a metric, a score? And then I forgot to check what it said. So, because I was busy preparing for my US show. Hold on.
Well, when you do that, I can give you, I remember many years ago, 20 years ago or so, Roger Montgomery answered that question, I think it was Roger, by saying that he would take the annual report from 5 years ago and look at what the MD said he was going to do and then see if it actually happened.
Is that able and... Oh, I guess that's able. I'm not sure it's about honest, but yeah, it could do that.
Pretty hard to score.
Well, this is what Gemini said. This is the right question to ask. If you rely on feeling whether a manager is honest, you'll be charmed by the charismatic ones who are often the most dangerous. Oh, Somebody should write a book about that. To channel Munger, we need to move from judging character to measuring evidence. Here is the objective Munger quality scorecard. It's forgetting that it was Buffett and Munger for a moment, but anyway. You can calculate these 4 metrics using data from the company's annual report or a standard financial terminal. Phase 4, the Munger forensic check. Pass, fail. Do not buy the stock unless it passes at least 3 of these 4 forensic tests. 1, the earnings reality test, cash conversion ratio. This tests if the profits are real cash or just accounting magic. The metric, operating cash flow over net profit after tax. The Munger standard, ratio should be greater than 1. The logic, in a healthy business, cash flow should basically match profits. If a company reports $100 million in profit but only $50 million in cash flow, they're likely stuffing channels, delaying payments, or capitalising expenses. How would you report $100 million in profit but only $50 million in cash flow?
Yeah. You've got to have positive impacts on the profit and loss, haven't you?
The bullshit earnings ratio, statutory versus underlying. And it put a star in the eye for bullshit, so it didn't actually swear. It just pretended to say the word. So apologies to people playing this for their kids at home. This measures how much management is trying to fool you with adjusted numbers. The metric, underlying adjusted earnings less statutory earnings over statutory earnings. The Munger standard, the difference should be less than 20%. The logic, if underlying profit is 200 million, but statutory... Why can't I say that word? Statutory profit is only... Stat profit. Yeah. Is only 50 million. Management is claiming that 150 million of their costs don't count. Munger called this auditing with an eraser. If the gap is huge, they're lying to themselves and you. 3, the skin in the game check, the Appendix 3Y test. In Australia, directors must file an Appendix 3Y whenever they buy or sell shares. This is public data. Did you know about that? Is that real?
Yeah.
Or is he making that up?
No.
Oh, okay.
I've had a couple of those notices sent out about Klein.
The metric, net insider buying last 12 months. The Munger standard, look for on-market trades buying with their own money. Pass, insiders are buying on market. Neutral, no activity. Fail, insiders are selling into a buyback or selling less than 10% of their holdings. We should talk about Drone Shield. Reading the Drone Shield news this week. I thought about putting that in the notes, but they're not really a QAV stock, so I didn't bother. 4, the $1 test, capital allocation efficiency. Warren Buffett's litmus test for whether management is smart enough to keep your money. The metric, change in market cap last 5 years over total retained earnings last 5 years. The Munger standard, ratio should be greater than 1. The logic, for every dollar of profit the company didn't pay you in dividends, retained earnings, did they create at least $1 of market value? So anyway, that's the 4 things I think we should look at to decide the able and honest test. What do you think of that?
Because Warren and Charlie have said it, I think a lot of it. Whether it adds much to the checklist, we'd have to regression test it and see.
There you go.
Yeah, I mean, we've also, in a shorthand way, used owner-founder as well, because it's a large shareholding belonging to the founder. These days, it doesn't always work because a few of them have turned out to be dishonest and unable to run the company except in their own interest. But generally, if they have a large shareholding in the company, they're pretty good at running it and in growing it. So that's been a good proxy, I guess, in the past at least for able and honest management.
Well, I was thinking of it in terms of our governance red flag too. Like, we have decided that if there's any, what we think, dodgy governance, we're going to red flag a company. But that's sort of a retrospective thing. It's not something we score in the checklist.
Yeah, I wasn't aware that Munger had these as hard scores. What's the source for that?
Well, I don't think he says it's hard scores. He just said Buffett said we look for companies run by honest and able managers, able and honest managers. So,
and then Gemini said try these ratios.
I said to Gemini, how would I score that objectively?
Right.
I mean, Buffett would go and sit down and meet with the managers and have conversations with them, I guess, and, do a litmus test based on his and Charlie's read of them, but we're not going to do that.
As long as they came from Omaha, they were good.
Yeah.
Yeah.
Pretty much. Quick portfolio update, Tony. Dummy portfolio all time 16.3% per annum versus 8.6 for the index. Last 30 days, we're down 5.4% versus the index. No, sorry, we're down 3.2% versus the index down 5.4%. So we're down, but not as much. This financial year, we're up 20% versus the index up 1.4%. Holy crap.
Yeah, that's a big difference.
20 times. That's the new benchmark. 20 times. That's what we're going for.
That's our new marketing headline, is it? They'll get us banned on Facebook for sure.
Yeah. Looking at the light group of portfolios, this financial year up 22% versus the benchmark up 1.4. Holy crap. What is that? ASG up 85%, NWH up 72%, CLV up 69%, PRN up 68%, SRG up 64%, PRU up 60%, RRL up 60%, RSGLLV up 55%. Whoa, man.
As opposed to Combank down 20. So,
yeah. Light group all time up 19.64 versus the index up 10. So not 20 times, just double. But down a bit. Obviously the market's been going through a bit of a hiccup last month. We're down 2% last 30 days versus the market down 5.5%, as I said. Anyway, pretty good. Pretty good. Had to sell EZL from the light portfolio yesterday, though, Tony.
Have you looked at it today?
I have not. Don't. Don't
well,
do
it's
that.
One of these stocks that's climbing upwards, but it's touching its sell line as it does it, because the low points are on the upward trajectory.
Don't do that, Tony. You know the ex-girlfriend rule. Now you've made me do it. Let me see. It's at $1.02 today. I sold it at 98 cents yesterday. Great. I sold it at a profit though. We're up 3%.
Okay.
But the sell price was I don't know. I've hidden that column. But I replaced it with CLX, CTI Logistics, which is up 1% since yesterday, so not all a loss.
So new girlfriend is at least as good as the old girlfriend.
So what else did I have yesterday? Nothing. That was it. What else have I got to talk about? Just some highlights I want to go through quickly. MAH, I'm looking at our portfolio. MAH, McMahon Holdings, bought it for a light portfolio on the 3rd of November, 3 weeks ago. It's up 20% since then. Had a look at the announcements. Nothing. Couldn't see anything since then. Nothing in the last 3 weeks. But up 20%. Good job. But then I was just updating the, I keep the pulled pork running list, and I update it sort of once a month. And I was going through, just looking at the pulled porks. There are some absolutely bonkers results of companies you've done pulled porks on. I'm just going to run through them quickly. One was Vault Minerals, VAU. You did a pulled pork on the 5th of August this year. They came out with their results on the 21st of August. Share price jumped up 11%. Then they announced a 13 for 2 consolidation. And the share price is up 80% since you did the pulled pork on it.
Including the consolidation?
Including the consolidation. Wow. And I can't figure out exactly why, but they have done a couple of announcements of different things. I think their share price, their ticker has changed to VAUDA too for some reason.
Oh, that's a deferred allotment. So, as part of the consolidation, it just acknowledges the fact you don't get the shares straight away. It takes a little while for the admin to kick in. So, they give you like a note in between, which is the DA.
But the share price is the same thing?
It should be, yeah. They should just all convert back into Vault shares again once the paperwork goes through.
Yeah, right.
Yeah.
Yeah. So, it was... What date is that? 20... Oh, what the... Oh, God, it's up like even today. Yesterday it was trading at $4.36. Today it's $4.70. But if I go back sort of 3 months ago, I get this is taking into account the consolidation. Go back to August, it was trading at $3.20. Now it's $4.70, as I said. So yeah, that's a crazy one. So congrats to anyone who got on that after you did the pulled pork. WGN, Wagner's holding company, you did a pulled pork 11 months ago, end of December, 27th of December 2024. That's highly unlikely. We normally don't record that week.
I do recall doing a pulled pork on them. They're a company out of Toowoomba, of all places, have a little airport up there they made themselves, and they're a concrete construction business who are doing a fair bit with recycling materials.
Well, at the time you did the pulled pork, the price was $1.39. The price is now $3.41. It's up 146% in the last year. And you asked me off air if they'd done a consolidation or anything. I couldn't see any mention of it, but
I think they've done a share issuance, in fact, so it should have been diluted.
Yeah, but they came out with their results announcement in August, and it kind of blew up massively then. Let me just... In stock I think it jumped jumped 16% then when it came out, but that doesn't account for all of the growth. But yeah, so that's a bonkers one. And then the one that really surprised me was Cettire, CTT.
Cettire.
So for people who don't remember, they were like shipping... Drop shipper to... And when the tariffs came in, and their share price crashed 30%. You did a pulled pork on the 20th of May. They're trading at 50 cents. The tariffs came in, they crashed 30%. Now they're at 68 cents. They're up 36% since you did the pulled pork. And so they crashed 30%. Now they're up 36, so they've recovered a lot. But then when I tried to figure it out, it's bonkers because they got removed from the ASX 200 in September. And the share price jumped 22%.
Which shouldn't happen. It should be passive selling.
It should go the other way, right? So I asked GPT to try and analyse it. Here's some theories it came up with. Once index funds sell, two things can happen. Forced selling finishes. Passive funds that were mechanically dumping are finally done. The stock stops drowning in selling pressure. Value investors step in. When liquidity from forced selling dries up, bargain hunters take over and snap up cheap cash-generating assets. Short covering. If shorts think the forced selling event is over, they exit, which pushes the price up sharply. Removal lowers forced volatility. Passive index reshuffles attract tourist capital that doesn't care about fundamentals. Once they're gone, the shareholder base becomes more selective. So I don't know if any of those theories hold any water.
Did you say tourist capital?
Tourist capital, yeah.
Okay. Well, this was also, I'm just looking up now whether there was any buying by the owner-founder, because he's often driven the share price, but I'm not seeing it.
I did see around about the time it was dropped from the ASX 200, there was an announcement that a company called First Sentient or something owned a big chunk of it, and they're mostly owned by Mitsubishi Group out of Japan. But I ran the announcement through GPT and it said, oh, that's not a new purchase. That's just, they just had to reveal that for some reason at the time.
So Dean Mintz is the owner. He bought some shares in September. So I know a lot of people were upset with him for selling shares. So perhaps they're seeing the buying as a good sign, and they followed him in.
Right.
Don't know.
Anyway, that was surprising. Other notables scanning down the list.
Sorry, it was surprising it was on the buy list in the first place because it was a growth stock. It was
right?
Yeah, it was one of those to the moon, where's the profit type stocks.
Yeah.
Based on sales, valued on revenues and hope and all those kinds of things. And then when it crashed, it became a value stock for a short time.
Well, there you go. Other notables when I was looking at the pulled pork list, EDU. You did a pork on it 16th of July this year, 38 cents. It's now 60 cents. I didn't have time to look into any of these ones, but it's up 59% since you did it in July. APM Animal Health, AHX. You did it on 13th of August at 54 cents. It's now at 87 cents, up 62%. On the flip side, Tyro Payments, TYR, you did on the 3rd of September. It's down 19%.
Yeah,
but then check this.
That could be on the basis. I think there's a review going into interchange fees, which might be affecting that one.
Ah, okay. Last one that I've got, SGI, Stealth Group. Remember them?
Oh, vaguely. This is going back a long way, isn't it?
No, May. Well, that could be long. Your age, I don't know.
I don't remember them so well. Are they? Which ones were they? Were they the people doing retail fit-outs?
No, they had like half a dozen hardware businesses, like retail outfits or something, from memory.
Yep, the tool centre.
Tool company, yeah. You thought they were going to be like, stealth bombers or something.
Yeah.
But it wasn't that cool. When you did them, they were at 23 cents. They're now at $1.20.
Wow.
Up 422%, and this is after they came out with their results on the 14th of November, like 10 days ago, and dropped 13%. They're still up 422%. On the 10th of November, just before they came out with their results, they announced that they were acquiring a company called Hardware and Building Traders. The share price jumped 58% that day.
Wow.
I remember it was a very small cap stock, so a lot of movement going on there. But it's up 422% since May. 6 months. Like, I keep crowing about that one I did in America, the smartwatch company that's up 700%.
The Chinese watch.
Like a watch, mother? Chinese watch?
Be ready at 8 o'clock. Storm.
Nudge, wink, say no more. But here's the thing that really jumped out at me, because I hadn't looked at your pulled pork list for a while, for a month or so. It's doing gangbusters. Like, I keep talking about how crazy the American market has been and the pulled porks that I've done over there and all of that kind of stuff. Your pulled pork list is just as impressive. Like the Australian stocks that we've looked at, just as if not more impressive, I think, on whole. The growth in the last 6 months to a year. I mean, all of them going back years, all looking really good. But which leads me to the new Reilly indicator.
Oh, sorry, I thought you were going to say the new Reilly service, where you write to us and we'll do a pulled pork on your business. If you're a shareholder who would like a quick...
Well, speaking of which, the
pump.
company that you did last week, I sent the CEO a message on LinkedIn, Joe Bartolo, and said, this is Simmel, and said, hey, you might be interested in this, and send him a link to it on YouTube. So he said, oh, thanks very much.
Okay.
That's all so far. That's my new thing. I'm sending the CEOs links to your pulled porks. So the new Reilly indicator, Tony. Now, you may recall, I certainly recall, because I think it was a major milestone in economics.
I can't believe you haven't got a Nobel Prize.
Yet.
Yet.
Well, I got a Napoleon medal. Like, I should be wearing this every episode. Yeah, look at that.
Wow.
Yeah, I should be wearing that.
That's solid gold, of course, isn't it?
It feels like it. It's heavy.
Is it? Oh, maybe it is.
Yeah, I don't want to bite it though. 806. Episode 806, I did the Reilly indicator, which was when we have nothing to sell for a long period of time. It was possibly a sign that the market was peaky. And I think it was. I think a week or two after I said that, the market had a correction. And when I did the buy list yesterday, I realised it was, when I looked at our buy list history, it was the lowest number of buys on a buy list since I've been recording our buy lists.
But you have made some changes to the buy list along the way, though, haven't you?
I have made some changes, and I take out anything with a ADT lower than 15. There are some that might be taken out because they're Josephines. Correct. And that kind of stuff. Yep. So yes, there are going to be some variations in it, but it was a lot shorter than any buy list we've had in history. The closest I could find was on the 3rd of October 2021, which we did an episode around about then, episode 440, which was called Gladys and Napoleon. We were talking about Gladys Berejiklian. That was, I think, at the end of her reign. And this is what was going on at the time. Delta, the COVID variant, was running around. We had the whole China Evergrande financial concerns. Delta was creating havoc around the world. Shockingly, US Congress was not able to agree on anything, and they were going to run out of money in a couple of weeks. Yet again, couldn't pass the budget. But even if I added the sub 15,000 ADT stocks back onto the list this week, it only added 4. So instead of 17, there were 21.
Yeah, but I think you weren't taking Josephines out of the old buy list too, and now you are. And that's something to watch out to for listeners. If they're using the buy list as published, it does change from day to day because some stocks are just off their buys, and if their price goes up a little bit, they become buys.
So I asked GPT to help me think through what this means. If there is fewer stocks on the buy list than usual. And it said basically, we had a long conversation about it, but the summary was this. When fundamentals are strong, but sentiment blocks 75% of those buys, because most of them are sentiment.
Yeah.
When I had a look at it, most of it's negative sentiment.
Yep.
But sentiment blocks 75% of buys. Fear dominates. Historically, fear at strong fundamentals precedes future gains. Out of 78 stocks that passed our QAV fundamentals this week, only 17 passed our sentiment test. That means about 78% of good companies are being priced like bad ones. When sentiment overwhelms fundamentals like that, it's historically a setup for strong forward value returns once fear lifts.
Mm-hmm. Does it say if fear keeps going though first and how long it takes?
No, it doesn't have a crystal ball, but
it's a good indicator, a good ratio to track.
So I'm now calling it the Reilly Sentiment Compression.
Okay, ratio?
Ratio. Yeah, the Sentiment Compression Ratio, the RSCR, Tony.
Uh-huh. No, well, there's too many acronyms. You need 3. 3-letter acronyms.
Well, I don't want to take the Reilly bit out, so...
Take the ratio off.
No, just the Reilly Sentiment Ratio. Okay. There you go, that'll do.
Mm-hmm.
So when companies are performing well, hitting all of our other metrics, scoring well, but failing on sentiment, it means that fear is driving the market, not underlying fundamentals.
Yep.
And maybe it's, projection about what they think's going to happen in a month with interest rates, or in 6 months, or blah, 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 blah. It's projection into the future. They're analysing the future. We're looking at today, where the money is today. But we also have metrics like forecast IV and those sorts of things that factor into our scoring. So anyway, we'll see what happens, but it looks like things are being pushed down for no good reason across our stocks at the moment. Like, it's one thing if the companies aren't performing well and their share prices are being pushed south, but if they're performing well and the sentiment is still negative, it's irrational and perhaps irrational, and it may be an indicator.
Yeah, it's definitely worth tracking. It's a market, so if people aren't feeling confident enough to buy, it could be for all sorts of reasons, macro reasons. I mean, Bitcoin's down 30%. Maybe they can't afford to cover their shorts on Bitcoin or something. They can't afford to buy into our market. Who knows?
Well, I was going to stop there, but you've just forced my hand. So, Christopher Joy,
well named,
Joy to the world, in the Financial Review, never returns my calls, says in the Financial Review this week, is Bitcoin the biggest honey trap in history? Depending on your timing, the cryptocurrency, which possesses all the hallmarks of a Ponzi scheme, could easily be the best or worst investment you've ever made. Last week, this column happened across one of the world's most successful crypto bankers who helped service the industry's luminaries, including FTX and its founder Sam Bankman-Fried. It's all a fraud, this billionaire banker suddenly exclaimed. This was not the expected greeting. It was devised by Western security services to entrap nefarious actors, and that is exactly what they have done, the erudite European continued. Could the crypto craze be coming to an end? Several days ago, an avid Greek crypto junkie pinged me and asked, are we seeing a return of the crypto reaper? That is the unfortunate moniker this column earned when it was outed as a deeply skeptical digital currency bear back in December 2021. Anyway, he goes on to put forward this theory, expand on this theory that, it's sort of a bit of a honey trap. Some interesting insight here. So, beyond possessing all the hallmarks of a Ponzi scheme, there have been several bona fide sources of crypto demand. Perhaps the best use case for Bitcoin is as a store of wealth for those living in non-democratic states who want to squirrel away cash beyond the reach of their overlords. Digital savings that transcend the nation state make compelling sense in that context. And ever since Russia had its US dollar reserves frozen following its tragic invasion of Ukraine, the greenback's role as an insurer of last resort has been called into question for those not allied to the great hegemon. I don't know if we talked about this on the show already, but I did have a conversation somewhere recently about one of the reasons the gold price is up is that China and Russia are buying gold because they don't trust the US not to freeze all of their US dollar assets.
We talked about it last week on the show.
We did. Okay. Yeah, right.
Alan Treadgold's article about gold.
Oh, that was it. Yeah. You that was great. That was a really great insight. This explains the recent de-dollarization fad, which this column suspects is a temporary dynamic. Every non-democratic country on the planet, including notably China, is assiduously dumping its US dollars in favour of gold, cryptocurrencies, and anything else likely to be impervious to Western influence. But if America controls the AI revolution, as it surely will, I disagree wholeheartedly, the US dollar should eventually become ascendant again. For the avoidance of doubt, our views on crypto have not changed. It is not an inflation hedge. In the worst inflation shock since the 1980s, Bitcoin fell almost 80%. It afforded no protection whatsoever. Au contraire, it exacerbated losses. It is not a stable store of wealth. In fact, one is hard-pressed to find anything more volatile. It is not a portfolio diversifier. It is almost perfectly correlated with stocks and is a pure, unadulterated volatility amplifier. I love that. A volatility amplifier. It is not a medium of exchange. Decades after its inception, we do not use crypto to buy or sell anything save for other leveraged crypto. It is simply a tool for mass speculation on the value of an asset that is worth absolutely nothing. More fundamentally, Bitcoin is not cryptographically secure. It is vulnerable to many vectors, including 51% attacks and quantum threats. America's peak electronic spy agency, the NSA, developed and publicly released the cryptographic hash function SHA-256, which the blockchain is predicated on. The NSA is not in the business of creating security tools that it disseminates to the public for free, but cannot itself crack. That seems highly implausible. The NSA's legislated reason for being is to both protect and steal secrets. It did, after all, develop and arguably weaken SHA's 256's predecessor, SHA-1. That may be why the Chinese prudently banned Bitcoin. It could also be why the mythical altruistic billionaire Satoshi Son, who supposedly authored the Bitcoin white paper in 2008, could just be a pseudonym for a Western intelligence cell. Language analysis suggests the paper was written by American and English authors. The 1.1 million Bitcoin held and bizarrely never touched by Satoshi Son are worth about US $96 billion. That has all the hallmarks of a nation-state enterprise. Bitcoin could, therefore, be the biggest honey trap in history. You convince those who are up to no good that they should harness an anonymized digital currency created by a benevolent ghost to ensure their wealth remains beyond the reach of law-abiding nation-states. It is the ultimate libertarian play. Put your money in this secret, dark and secure digital place that governments can never touch. Gullible Bitcoin acolytes should consider the possibility that it was engineered by governments for precisely that purpose, to track your every move and, in extremis, seize control of your assets. Anyway, it goes on. It's a great article, and I was like, oh,
Yeah.
That's brilliant.
Yep, I agree. I read the article too. Yep, I hadn't seen it that way before myself.
I'm gonna not donate. I'm going to today's Napoleon Medal Award goes to Christopher Joy for blowing my mind with that article this week. Particularly the bit about the whole Satoshi thing, and our friend Torsten, who helped produce our film, the posters behind me, did 2 documentaries on Bitcoin, and interviewed all of the key players at the time about who Satoshi was, including the Australian academic who claims he's Satoshi, but no one really seems to believe him. Maybe it is,
George H. Bush.
the NSA. Yeah.
Yeah, quite. I mean, it's great honey trap. It's like that opening scene in Sea of Love where the cops raffle off a boat and give all the crooks a free ticket.
I was just talking about that film the day before yesterday. I was playing, Chrissy and I were having dinner, and I put on YouTube on the TV like some US, somebody had ripped a VHS of some late night video show from 1984, including the ads and everything, which we always love seeing, like the 80s American ads in the music show. But they had Robert Plant's cover of Sea of Love, and I was saying to Chrissy, so that came out in 84. The Pacino film came out in 86 based on the song, but they used the original version in the song with Ellen Barkin.
Yep.
Ellen Barkin
John
is
Goodman.
the crazy lover. John Goodman and Pacino. It was Pacino's sort of comeback film after a couple of years of duds.
Yep.
And I was going through, I was like, yeah, she was like, I don't remember. I go, yeah, I'm sure you watched it with me. I've seen it a bunch of times. Like, I love that film. Great film. And it's weird that you just mentioned it. Like, I was just talking about it 2 days ago. Anywho, yes, they do so tell people who haven't seen it about the scam that they do, or not the scam, the whatever.
Well, it's a scam. It's a honey trap, yeah.
Honey trap.
Which I think was actually based on a real life event.
A real thing, I think it was, yeah.
So the cops raffled a boat and gave out tickets around the hood. And then when all the crooks came in, they said, you just got to go into the auditorium and we're going to do our draw and just go and take a seat. Sign here, off you go. and they all go into the auditorium, and as they file in, they get nicked. So they've all got resolved warrants, outstanding warrants. Yeah.
Outstanding warrants, yeah.
And then
And
the
then
very
just get
end,
them all
to sort of a script writing hack, which is called Save the Cat, about how you make the good guy look good, is Al Pacino stops the last bad guy from coming in because he's got his little 6-year-old toddler with him, and he says, "No, we're closing the doors. It's too late," and sends him back outside.
Yeah. Great film. Anyway, so that's my Bitcoin story for this week. What do you got on your list of talking points?
Kind of a similar sort of theme. I know it's not value investing, but a lot of people are speculating what's going on in the US market at the moment. Our market went down last week when the US market tanked quickly, and then went back up as quickly earlier this week. And it's all being driven by AI. And there were 2 articles in today's Wall Street Journal. I won't bother going to read them now because we've taken up a lot of time already, but the 2 points that I wanted to highlight were most of the growth in the US economy this year anyway, and probably in recent years, has come from AI investment, either in chip manufacturing or buying, or construction of data centers to house the chips, or in the construction of power producing assets, transformers, dynamos, whatever you want to call them. And in fact, a couple of Bitcoin miners who were making a name for themselves by having alternative energy powered data centers to do the mining have now flipped, and they now power AI data centers. So they've done well out of that. But if you take out all of that investment, the US economy looks anemic, according to the Wall Street Journal. So that's usually not a good thing. However, the US market is holding its breath to see what the Fed does. And if the Fed cuts rates, then the market will see that as a good thing, and it will get another leg up. As I've said many times before, we're in this kind of going through the looking glass world where everything's topsy-turvy, bad news is good news. The other thing which is happening, and this is where I guess it's worth focusing on, is in the bond market. So a lot of companies in the FANG sort of sector, or the big 4 anyway, your Metas and your Alphabets and Google, etc., and Microsoft are funding their AI investment via cash flow. So they're not issuing a whole heap of debt to build data centers or to buy chips. But some of the other players on the periphery, Oracle, I think it's called Dreamcore, Cam. I think it was a startup or a recent listing in the AI space. They've both been trying to grow their presence by issuing bonds. And that debt is now, after a lot of issues, now starting to be worth less and less. So it's demanding a high yield. So in other words, if someone wants to take up a new bond that an AI company is issuing, they're comparing it to the old issuances, and they're doing an assessment as to whether this company is going to be around for the 5 years or 10 years or 3 years or whatever it is that they need to last to pay the money back. And so the buyers of those bonds are progressively charging more and more yield. They want more for taking on that risk. And so this is starting to cramp at least the peripheral side of AI, which I think is very interesting. So does that mean that there'll be a slowdown in AI investment? Potentially, although the big companies will probably still have enough cash flow to keep doing it themselves. But as economists have always pointed out, the share market is beholden to the bond market. And if it wants to issue debt, then it's got to be done in a prudent way to convince the market that the company is going to be around and to be able to redeem the bond coupon in the period that the bond is issued for. So I guess where I'm coming to is that the bond market is starting to exert a bit of pressure on AI investment, which is not a bad thing. So that may slow. But if it's the only thing that's growing in America, the US economy may slow. And that would usually be a bad thing, but it could lead to a rate cut, which would be seen as a good thing. So it's very, very topsy-turvy. One of the authors in the article said, the way to know if the market thinks there's going to be a definitive rate cut is to look for Bitcoin improving in value, because they're the ones who rely on it the most on sort of free, frothy money and cheap money to invest.
Yeah, well, it's it's an interesting time with all of that. There's I've seen a lot of interesting analysis too on the whole AI bubble, so to speak. Here's a question for you. It's what I've been thinking about for the last day or so. If we were 100% confident that the current AI track that we're on, if we give it enough investment, could, in the next 20 years, cure all diseases, resolve climate change, and eradicate global poverty, how much should we invest in it?
No, you should invest everything in it if you're that confident.
Right. If we're 80% confident, how much should we invest in it?
Yeah, well, it depends, isn't it? It depends on the risk curve. If it's a 45-degree angle, then 80% you should invest a lot. But if it's asymptotic and you need 81% before it takes off, then you shouldn't invest much.
Interesting. Well, it's already taken off. So, yeah. I was listening to an interesting podcast yesterday. It was the OpenAI podcast, and it had two guys who work in OpenAI were being interviewed. And both of them are former physicists who now work in AI, but they're working on the science side of it. So OpenAI has just launched a thing copying what Google's been doing for quite a while, where they've got like a dedicated version, an internal version of ChatGPT that they're working with scientists, physicists, and people working in medicine and stuff like that to amplify what they're doing. And they were talking about some of the stuff that it's already doing with scientists, the scientists are using it for. But these guys were speaking, very hyperbolically about what they think AI is going to be able to do in the sciences in the next 10 years. And they were saying, if you're where it is at the moment, they were saying even today, the latest models that they have internally are probably able to do the same level of thinking as an experienced PhD. But they said, they were talking about problems they were giving it, and they were like, I could have worked this out, but it probably would have taken me several days. Mm-hmm. It did it in an hour while I was doing something else. Mm-hmm. So it's not smarter than me, but it's just
more productive,
a lot faster than me. Yeah. And they were saying then, a lot of science is done by trial and error, right? I've got this hypothesis. I think there's an experiment that could verify it. I'm going to go run this experiment. And it takes time and effort to run that experiment in the real world. Whereas with AI, we can go, well, give me 100,000 alternative experiments that could be run and run them all in parallel.
Monte Carlo
tell me
simulation.
which one. Exactly. Tell me which one has the best results, and then we'll go do that. And they say, okay, so that's one thing if you have one scientist doing it. Imagine you have 10,000 scientists running hundreds of thousands of things in parallel.
And then cross-checking their results and passing their results on to the next one.
Yep. But the other thing is they were saying, any scientist today is specialized in their field because you have to be. You can't read every paper in your own field, let alone every paper in every other field, and looking for things that, parallels in research, in maths, in biology, and chemistry, and whatever, economics, social dynamics. But the AI does read every paper that's written in every language on every topic, and it can cross-reference, findings and concepts. So anyway,
well, it's impressive stuff. But let me flip your question around and invert it. If you knew that,
all right, Charlie,
if somebody knows that we're going to hit utopia in 20 years if we invest heavily in AI, why aren't we spending 100% of our productive capacity doing it? It's because we're not sure.
We're not sure. We're not 100% sure that the current path is going to deliver results. But I think the people working in the sector are 100% confident that the trajectory that we're on is going to deliver those results. It may not be large language models all the way, but it will be large language models which will lead to the next breakthrough, which will lead to the next breakthrough, which is what Kurzweil's been talking about for
Yeah.
40 years, right?
But it's also
It's the increase of intelligence which leads to the breakthroughs
Yeah.
that builds on itself exponentially, right?
Yeah, so what's the best paradigm then for resolving that paradox? It's got to be a market, hasn't it? Allocating capital based on people's assessments of the upside.
Which is what's happening
Yeah,
in the US anyway.
Yeah.
And in China, it's the CCP just saying,
yeah.
okay,
Well,
we need to win this. Let's go.
the CCP mustn't believe in utopia if they're not investing every spare dime they've got into AI. Otherwise, they would.
Well, I think they're increasingly regrouping around that.
They are,
Yeah. Anywho,
Anyway,
back to you.
Back to stocks. Interesting post on the QAV Facebook page from PC asking about Credit Corp. Not Credit Corp, sorry, cash converters, the other CC code. Cash converters, and I did a pulled pork on them, I think last year as well. And he wanted to know whether they were right for takeover because they have a company with a large shareholding. So I think from memory it's 43% now, called Easy Corp, which is an international company in the same space who's been slowly growing their shareholding in cash converters for quite a while now. It looks to me like, I can't answer that question because who knows, you'd have to ask them if they're going to take over, if Easy Corp will take over cash converters. But it's an interesting case study of what happens in the market sometimes. And I think the most recent example was in the case of Boral, where Seven Group Holdings had a large stake in Boral, which was a cement company. I think cement and also got into construction materials. And eventually it was taken over by Seven Group Holdings and taken off the market and incorporated into SGH, which is a listed company. And they used a well-worn playbook that investors can use. And to backstep a bit and talk about the Corporations Act, if you buy into a company and you buy more than 20%, you must launch a bid for the company. You can't sit at 20%. So companies that are interested in doing takeovers will often buy 19.9% of a company and then consider their options. That is usually enough to give them a seat at the board table so they get to look at what's actually going on, and then they can form an opinion about progressing or not from there. The Corporations Act does give a company in that situation a hall pass from going above 20% if it limits its buying to 3% every 6 months. And that's called the creep provision in the Corporations Act. It looks like Easy Corp have also done this, so they've slowly taken their stake above 20% and now sit at 43%. So they've been doing it for a long time. In the Easy Corp situation, it looks to me like they took a stake in cash converters before there was a change in payday lending laws in Australia. So I think, I'm not an expert on Easy Corp, don't even know that much about cash converters, but cash converters are a franchise of what we used to call pawn shops, and they eventually smartened up the way pawn shops look and operate, and then got into payday lending. So if you think about how a pawn shop used to work, I'd take my guitar down to the pawn shop and say, hey, I need $50, and they'd say sure, and they'd hold it for 30 days and give me a chance to buy it back at maybe $60, which was a 20% interest rate. Otherwise, they'd slap $80 on it and try and sell it. And I could buy it back at $80 at some later date if I wanted to, but so could anybody else. That's a short-term loan, in effect. And then eventually the market smartened up to that, and cash converters started giving people loans, either on secured items for a short period of time, which they'd hold as security in case of default, or sometimes just from the point of view of, hey, we'll give you an unsecured loan for a high interest rate until your next payday. So you've got an unexpected bill, you're being paid monthly, we'll fund that gap for you. I'm not even sure if cash converters were that open about it, but they may have still required security. I can't recall. The government stepped at some stage. Easy Corp said, "Yeah, that's one of our core businesses." They took a stake in cash converters as a way of expanding overseas. The federal government stepped in, not because of that, but just in general because the payday lending market was getting a bit crazy and people were being charged high interest rates, and there were some bad results from defaults, etc., and people's lives were ruined by these high interest rates, and so they set up a whole series of rules. And that kind of slowed Easy Corp's appetite to buy into cash converters. But they stayed on, and it's been good for cash converters. They recently did a capital raise to fund a rollout of new stores, and that was participated in by Easy Corp. So that was a good source of funding for cash converters. But within about a year, so Easy Corp sitting at 43%. In 2 more creeps, they'll be at 49%. In 3 more creeps, so in 18 months' time, they potentially could have dominant control of the board. So they have more than 50% of the shareholding, which puts them in effect to be the default operator of cash converters. In cases like that, that does give them the whip hand as to what they do from there. They could continue to use the creep provision because they effectively control the business and they own a majority of it. They might decide that's a good way to operate for them, but they're not allowed to consolidate cash converters' finances into their own finances as a complete whole subsidiary unit until they take it out completely, own 100% of it. So sometimes in a situation that's enough, and they get control. They decide they like what they're seeing. They like the way they can move the business, which may not be in the interest of minority shareholders, by the way, and they'll launch a takeover bid. Because they own more than half, it's very difficult for anybody else to launch a counter bid, and therefore the bid is not going to be at a high premium. And which is what happened with Boral, and they were taken out, and now Boral has been doing very well in the 7 Group stable of businesses, which includes Caterpillar and other brands like that. So there was a bit of a synergy there. This may happen with cash converters. So I guess the point of the story is it's probably got 18 months to run in terms of takeover. And this is not to say that Easy Corp won't launch a bid anytime between now and then. But when they do get to more than 50%, then they may launch a bid, but it may not be at the normal premium that you'd expect. And you want to make sure you don't get acquired off market, which they can do when they compulsorily move to acquire once they have enough acceptances, because you'll be stuck in Easy Corp shares, which may be good, but you may not want to be there. So just a few things to be aware of. I guess if I was a shareholder, I'd wait and see. The business is doing well, and it's been on and off our buy list for a long time. But I wouldn't be holding my breath for a big takeover from this one.
Well, you did a pulled pork on them on the 10th of September last year. They're up 33%, 33% since then. But the one you did the following week was GNP, Genus Plus Group. They're up 171% since you did that.
Well, anybody who bought cash converters should have waited a week then.
I must have missed them when I did my quick scan down the list before, but yeah. Good stuff. CCV. What else you got?
I think that's it. I've got a pulled pork to do on Aurizon Holdings.
Well, before you do that, I want to ask you a question. Mm-hmm. Do you have a bunker?
Well, if you don't count Cape Shank, no.
That is your bunker.
Yeah.
I saw this AMA on Reddit this week. I build billionaire bunkers. Ask me anything. I've been building billionaire bunkers and doing related work since 2020 all over the world. Feel free to ask me anything. And it's fascinating, assuming this person can be trusted. He basically says he's been doing a lot of it. I worked in this space for governments and corporations, then hopped over to help the millionaires and billionaires. Totally bespoke, generally costs multiple millions, usually takes 6 to 9 months. Says, they're building them for a bunch of reasons, but apparently it's a huge thing. Civil unrest, nuclear attacks, pandemics. They have all the comforts you would expect, including gyms, spas, cinemas, amusement arcades, etc. There are usually rooms for household staff and extended family. They are essentially creating a small self-sufficient community.
Stocked with Bitcoin and gold.
About 80% of my work is conducted through family offices. I was just looking for his. He was talking at one point about how big they can be. From memory, he said they can be the size of an apartment through to the size of a football field, with all sorts of accommodation and rooms and gyms and cinemas and that sort of stuff in Europe and North America. I mean, it's a fascinating topic, the whole billionaire bunkers thing. But I often wonder, like, what do they think's going to happen when they finally come out? Like, if a big enough calamity happens that you need to go into a bunker, assuming it's a pandemic and it passes in a year or so, whatever, okay, that's fine. But if it's nuclear war or some other major global meltdown, what do you think's left when you come out? I guess
Certainly no worker bees to do your work for you. And then it's going to be you fighting Elon, so good luck.
You, one of the few people I know who could afford one of these, along with Dennis Bastis and Mike Cannon-Brooks and my other billionaire friends. Have you ever thought about building a bunker?
It's a ridiculous strategy.
Tell me why.
Well, it's it was. I remember it was a thing when we were in New Zealand, and the government eventually stopped rich Americans from buying.
Like Peter Thiel?
Yeah,
he's got one
buying
there,
into New Zealand to put their bunkers there because they think New Zealand will survive a calamity. It's probably the most shakiest country in the world, so not sure if that's smart. I mean, maybe it prolongs. It's a bit like a survival, like the bomb shelter things and nuclear fallout shelters in America in the 50s. You're not going to be able to survive forever in it, and when you come out, you may not be able to breathe the air, or you're going to find that society's gone and you're going to have to try and forage for yourself, and you probably last 5 minutes up against the giant cockroaches that survived or whatever. So I just don't see it as being. But the rational argument is that it might not get as bad as that. It might just be that you're leaving America because Trump's now the almighty dictator and you don't want to live there anymore or be a part of any sort of octopus arm that can be extended from America to get you.
I think a lot of the ones that he's building are in America.
Right.
So they're building them
right.
in America. I did like the comment that somebody made. Do they realise we're just going to lock them in there?
Weld the door shut, yeah.
Yeah.
The B-Arc. The B-Arc strategy from Hitchhiker's Guide.
Yeah. So, okay.
Yep. And, I remember also, too, on a similar sort of note, friend of a friend took us through a tour of their house out in the outskirts of Melbourne, was in a forest fire area, and their solution was to build a fire bunker, which was quite expensive, and it's underground, and they took us through it and showed us, and you can survive for 3 days in there, and composting toilets and all this kind of stuff. And it's a big steel door that shuts, and all I could think of was the word oven. It was just like preparing yourself in a wood-fired pizza oven under the ground to survive a forest fire. Seemed pretty strange.
Apparently Douglas Rushkoff interviewed bunker owners for a book in 2022. He asked one billionaire who'll repair the pump in his bunker's swimming pool if it breaks down. Says, dude misses the point and adds pool pump components to his shopping list.
Yeah. Well.
I guess if you got enough money to piss away, then why not build a bunker? Who knows?
Yeah, why not go and immerse yourself in cryogenic freezing to extend your life, all that kind of stuff.
I'm totally for that.
Oh, yeah?
Oh, yeah.
You're going to put your billions, you're going to pawn your Napoleon medal and buy a cryo chamber.
My solid gold Napoleon medal. Yeah, no, I was looking into... I'm still a part of the Cryonics Association of Australia. I still get their emails. I have been since the, mid-90s,
Ice Ages.
Maybe, I think. But, that was the idea that, okay, let's say we're on the verge of immortality and I get a brain tumor or something, or cancer, or okay, well, if I can put my body in cryonic suspension for 20 years, 30 years, there's maybe a 0.001% chance that I'll be brought back, but it's better than a 0% chance.
Especially when we lock the door.
Yeah. Chrissy will be like, oh! To the next chapter.
Yeah.
Okay. You want to do your pulled pork now, seeing as we're getting up to an hour and we haven't even got to there yet? Over an hour. Oh, my God.
Yeah.
Sorry.
That's all right. I'll try and be as quick as I can. Aurizon Holdings. Now, I've done Aurizon before, but it was quite a few years ago. It's back on the bottom of our buy list. Its QAV score is 0.1, so it's the very last stock. And I've included it today, A, because it's new on the buy list, but B, because it's a large ADT stock, so it will suit large shareholders. I've owned the stock in the past, I don't own it now. It comes out of a government float back in 2010 of a company called QR National, which, as you'd expect, is a rail haulage company in Queensland. And it was listed originally as QR National and then changed its name to Aurizon Holdings. The market has got a hold of it. Its basic business is hauling coal from the Queensland mines to terminals on the coast. So if you don't like that, if you're ESG oriented and don't like a coal haulage company, then look away now. They do make a bit of a play with the statement that hauling things around Australia using rail is the best or the lowest emitter of carbon than compared to road or air. So they do make some claim to be less carbon intensive, but anyway, you can make your own decision on that. It's started off life owning the rail tracks, which I think it now leases from the Queensland government. It also allows competitors onto the rail network, but it's also diversified away a lot from hauling coal from the Bowen Basin to the Queensland coast and loading it on ships. It now does a lot of iron ore haulage, it does a lot of grain haulage. It runs the rail networks between Darwin and almost all the way to Adelaide, so in the outback and as well over in WA. So it's diversified away a lot from coal. But it still does a lot of coal haulage. What else can I say about it? That's probably all I want to say about it in that sense. It was listed, the listing was fairly contentious, I remember, because I was investing around the time when it was listed. The sort of thematic was that this was a government-owned business, and government-owned businesses, when they were taken out of government ownership into private hands, had a profit bump because private ownership could do more with the cost base, more with efficiency, was less beholden to unions, that kind of thing. And certainly that had been the case with some of the listings before that, most notably CSL. But over the years, even though the stock price went up, it's now back around where it was when it listed some 15 years before. So it listed at $2.55. Price today is, I'll have a quick look, it was around $3 something, $3.10 I think, when I did the analysis. No, $3.53, so it's actually climbing, but it did get back around to its listing price back in May of this year. They reported bad numbers in their latest results, so they reported a 25% fall in net profit after tax. And they claimed that the group earnings were pressured by weaker bulk haulage, containerised freight losses, impairments due to companies not being able to pay them, and higher restructuring and legal costs. So they also provided guidance at the lower end for growth, so a subdued earnings outlook. Dividend performance was also below market expectations. Final dividend of 6.5 cents fell short of the 6.9 cents expected, and this company is driven by its dividend yield, so that wasn't good. But interestingly enough, the market digested that, and now the share price is going up again, possibly because of the action that's been taken. So Aurizon announced 250 job cuts this year in answer to its profit decline. And they also increased their share buyback program. And the other thing that's kind of keeping the market interested is that they are thinking about what to do with the Queensland rail network. And the AFR back in August 18 reported that Aurizon Chief Executive Andrew Harding said, no decision has been made on whether to sell or keep the company's Queensland rail network, which earns steady income from operating and maintaining rail tracks. But the CEO confirmed Aurizon had been asking potential buyers to put a value on its network. And there's been a few articles around like that, one from the week before. Aurizon in discussions to sell $4 billion stake in Queensland Rail. Aurizon is in talks to sell up to 49% of its Queensland rail tracks, a key piece of infrastructure for the export of coal, seeking bids of up to $4 billion to arrest sliding profits and restore investor confidence. The country's largest rail freight business and its advisors have invited private infrastructure investors, hedge funds and insurers to take a highly confidential look at the 2,670-kilometre Central Queensland coal network. A sale of a minority stake in the network or spinning it off via the merger would be the biggest shake-up at Aurizon since it was privatised back in 2010, etc., etc. So there's a little bit of work going on there. So perhaps that's coming down to the sharp end. There's a few other articles about that too. And maybe the market's getting excited about the spin-off of that coal haulage business and network. But the other thing it may be getting excited about was on the front page of today's AFR. And there's a story announcing that Macquarie Group's infrastructure arm is launching a takeover for Cube Logistics, QUBE, which is partially a competitor, certainly in the infrastructure space for logistics. And I'm drawing a long bow here and saying that could lead to consolidation in the industry. May or may not, but certainly was a bit of an eye-opener, I think, in this space. I would classify this company as a bond proxy. We've talked about them before. They're kind of companies like, say, Dalrymple Bay, which is possibly where Aurizon takes its coal to. So that's Dalrymple Bay is the terminal which loads the coal ships and has a steady income stream of contracted work and then pays a high dividend based on its margin for doing that contracted work. So it's a bond proxy. So in other words, it's you give me your money as an investor for a while, I'll give you a dividend coupon, and the business will still be around in 10 years' time to pay you back. So I would have thought AZJ would make a good fit with a large super fund, or for a large super fund, and the large super funds have been busy hoovering up infrastructure type assets and then taking them off market to put into their own super funds as unlisted assets. And the likes of Sydney Airport come to mind and certain toll roads. So I wondered why Aurizon wasn't in that camp, given that it's part of its business anyway is regulated, it's monopolistic, and a defensive infrastructure business. But I think one of the reasons why it hasn't been picked up by a super fund is because of the ESG concerns with the coal exposure. So something like 70+% of Aurizon's EBITDA is still coal related, which is the network business and the haulage business. And even though those volumes are contracted and stable, the market applies a permanent ESG discount and assumes a long-term volume decline. Another thing which is made super funds a bit wary about buying a stock like Aurizon is that at the moment it's not going through a period of high capital investment, but it has in the past, and there's been a need to upgrade its network, its rail network, its rolling stock or its trucks, so it's trailers on the behind the engines, and what they call corridor maintenance, so the land around the railway. So it does have a high capex usage, which is not necessarily appealing to investors. And I think the last sort of reason for it is that it's no obvious growth story. So it's a mature business, which is not a bad thing because, like I said, super funds will take on those low growth businesses if they either can combine them with other low growth businesses. So oftentimes, if they buy one airport, they buy other regional airports as well and try and look for some synergies through management or combining them together there. But they haven't had a bite at Aurizon. But perhaps if there's consolidation in the industry, that may change and that might get some interest because the share price has been going up this second half of the year and based on bad results, so something's up. I guess in summary, it's not a broken business. It's not expensive. It's going to be around for a long time. It still has some monopoly-like characteristics. But I think it probably needs a catalyst before it sees a real upturn in share price, more than it is now anyway. Some of the analysis I read said that the non-coal bulk haulage rates had to probably double in scale to make it attractive and to offset coal. Coal has had a bit of a volatile outlook in terms of its shipments, and so some kind of stability has to come to the coal market to make this company more attractive. And I guess, once one takeover bid appears, I think it might garner some interest in this company. So that's what's going on with the business. If I can look at the numbers now, so it's a large ADT stock, 14.3 million. Stock price for my analysis was $3.51, which is greater than IV1 of $1.06 and IV2 of $2.42, and actually greater than consensus target of 5%. So we don't often see that, but it is in this case. Can't buy it for book or book plus 30, which is $3.03, so it's trading above that. Yield is nearly 4.5%, which is not bad, but we don't score it because it's not bigger than the mortgage rate. Stock Doctor Financial Health and Trend is strong and steady. Stockopedia quality rank is 80, which isn't too bad. And the F score is 7 out of 9, which is good. The overall Stockopedia stock rank was 82, and it falls down on momentum, which only ranks 53, because as I said, until the last couple of months, the share price has been going down. The PE is nearly 17 times, but it's not the highest or the lowest, so we don't score it for that. PropCAF is good. It's trading at 4.21 times. So that's the attractive part of this business, is it's throwing off lots of cash, notwithstanding the fact that from time to time it does have to invest back in itself as well from a capex point of view. Earnings per share forecast growth is 16% and potentially questionable by some of the analysts I read about looking at this company. But even so, even if it does do 16% earnings per share forecast, it doesn't score on our growth over PE anyway. Growth over PE is only 0.97. It doesn't have an owner-founder, and directors have very negligible ownership in this company. And that was another interesting tidbit, I thought, is the company's been run for about 10 years by an I think it was Rio Tinto senior manager, who I guess might be ruining the fact they left Rio Tinto. But I wonder when 10 years or how long is enough for this person, and whether they may countenance a rollout or a spin-off of the rail network or part of the rail network to try and get the share price moving again. Certainly the right time to do it. I mean, you can't spin off that network when the share price is high. It doesn't make any sense. But when the share price is low, you can get an attractive bid, which makes it more achievable. How can I summarise this company? I should sum it up first of all. The total quality score is 7 out of 16 or 44%, and the QAV score is 0.1. The company lacks quality. We're giving it 44%. Stockopedia was a bit more generous, but it's certainly made up for by stronger cash flow, so it gets onto our buy list on that side of things. Plenty of risks and opportunities for the company. Obviously, the coal side of the business, whilst being volatile, is an ESG markdown on its valuation. It's recently had a lot of disruptions to its haulage business, either because of floods or cyclones or industrial action, and there have been some derailments which have shut down their network for a while. So it's a little bit volatile from that point of view. As I said before, there is capex drawdowns from time to time, and there's also regulatory risk, not just around ESG, but also perhaps on the pricing that they have to get agreed by the government for the Queensland coal haulage. On the positive sides, if they do spin off some of the rail line assets, that may lead to a re-rating of the rest of the company and its valuation. And it also gives them a potential use of funds to go after consolidating in the haulage space as well themselves. But at the low end of their share price graph, they're, I think, potentially a takeover target. And if they do somehow split the coal business, I think it makes them even more attractive. So that's what is probably occupying the board's minds at the moment. So that's AZJ, Aurizon Holdings.
Any explanation why they're called Aurizon AU? Is it Australian Horizons? Is that what it's
I think so.
play on?
I mean, it was, yeah. Like I said, I remember it being a fairly contentious listing. There was a lot of conjecture that the Queensland government had a fairly efficient rail network going on, so the valuation that was floated at was too high, and then about a year or two later the market has got a hold to rebrand it. So it's always had a kind of spin side to the valuation on this company.
Mm-hmm.
And it did go up in price, but now it's back down to a little bit above where it floated.
All right. Thank you, Tony. Aurizon. I'll email their CEO and let him know. After hours.
Well, thank you for putting me on the Pluribus. That was fantastic. We've
How many
caught
episodes
up.
have you watched?
Well, four.
Oh, four?
Yeah, really
Yeah.
good. Loving it. Didn't.
It's an interesting premise, isn't
Oh,
it?
it's great. It's got all the best parts of the matrix. Plugging into the hive mind and solving the productivity issues. Just if you want to fly a plane, you just walk in and fly the plane because you plug into the hive mind. If you want to, clean up someone's house, you just walk up and clean up someone's house. It's just sort of tag and hand over. It's very interesting.
And I really like, and spoilers for people who haven't watched it, but I really like the premise that he's set up. There's the one scene where Ray Seahorn's character, Carol, is asking her main hive mind girlfriend contact thing about why they're going to force her to join the hive mind. And she says, if you saw someone drowning, would you wait for them to ask you to save them? And she goes, you think I'm drowning? And she goes, yeah, you just don't know it yet. Like the premise that they're all happy and they've found peace and happiness as part of the hive mind. They see that she's miserable and they're like, well, we want you to come and join us. And it has all these overtones of religious-y, culty
Yeah.
things, Mormons knocking on your front door, etc., etc. But yeah, interesting.
Great
The
premise.
premise are like,
Makes
well,
you think.
we're happy. We want you to be happy. Come join us.
And it's really shot well. There's some great moments of whimsical humour. Like, the lead character wants to meet the other half a dozen people who speak English and weren't taken over at the same time. And they all jump on planes and get flown into Bilbao in Spain, and you see all the airliners land at the same time, and just all nose into the terminal at the same time. It's so great.
I was reading an interview. Bob Odenkirk was interviewing Ray about the show, and he hadn't seen it. And she was explaining how it sort of blends this sort of sci-fi horror tropes with just comedy. Like typical Vince Gilligan, though, in all of his shows, he's able to just make it funny along the way, find the absurd humour in violence or tragedy or whatever it is. He's a
People
great
hanging
writer.
from cherry pickers upside down going, oh, hi, Carol, as she walks past.
Yeah. But you haven't watched The Chair Company yet?
No, I only heard about it last night for the first time.
Didn't I tell you about it?
No, I don't think so.
I'm sure I did
you?
tell you
Okay.
about it. Yeah.
No.
About this guy he's giving a talk in front of his company. He sits on the chair and the chair collapses and he believes there's a huge conspiracy going on from the chair company, and he just becomes completely insane, driven by uncovering this conspiracy. I don't know if you like it. Like it's typical Tim Robinson comedy. It's
Right.
like completely off the wall, trippy, really bizarre, but we dig it.
Yeah, I want to check it out. Looks good.
I mentioned, well, I haven't started the Scorsese thing yet, but I'm looking for the right opportunity to start that now that we have Apple briefly. As I mentioned to you before we started the show, my son in LA, Taylor, sent me a text yesterday going, do you know who this guy is? And this guy was Jimmy Barnes, because he didn't know who Jimmy Barnes was. And then Hunter, my other kid, called me 10 minutes later. I said, are you going to ask me who Jimmy Barnes is too? And he's like, who? What? I was like, oh my God. What country did you grow up in? How do you not know who Jimmy Barnes is? You millennial losers.
Well, they didn't have a working class man for a father. They have a Napoleon Medal recipient.
Who sings Flame Trees and K-Sun and, all the Chisel songs constantly in the car. But, even Chrissy was looking at the window at a tree across the road the other day. She goes, is that one of those flame trees you always sing about? I go, yeah, I think so. I got two music recommendations for you this week. You ever heard of the Four Horsemen?
Ooh, I think I have. Is that the bass player from The Clash? Is he one of the Horsemen?
I doubt it.
Okay.
No. Only made one album, and then they broke up because I think somebody died of a heroin overdose. But Rick Rubin produced it, 1991. Nobody said it was easy. British band, but play this rock that's sort of a cross between Guns N' Roses and AC/DC. It's not bad. It's not great, but I was listening to it this morning. It came up in a playlist that Spotify gave me, and I was enjoying it. Sort of that sort of bluesy, early 90s blues, heavy rock kind of thing.
Okay.
You know?
Yep.
Like sort of, AC/DC kind of blends the blues and the rock. So there's a lot of, 4-bar blues, kind of stuff. Anyway, not bad. But the other thing I've been listening to a lot is Ethiopian jazz that a friend put me onto this week. There's this fascinating... I've listened to quite a bit of Nigerian jazz, but I never really got into the Ethiopian stuff. But there's this whole thing about...
That's a great line. Oh, I've been listening to Nigerian jazz, but never got into Ethiopian jazz.
Don't know why you find that so amusing.
Well, what do you think about Mali jazz or Rwandan hip-hop?
There was this period of a decade or so when Haile Selassie was running Ethiopia, when there was this burgeoning modern sort of social cultural epoch, and a lot of their musicians went to America and came back and put a jazz overlay on traditional Ethiopian modal music. And then he lost power and, one of the military coups happened and it all got crushed. So it all disappeared. But there was a period of 10, 14 years or something. I think it ended in the early 70s. And there was a French musicologist a decade or two ago who spent a decade digging up archival recordings of this stuff and put it out in a series of 30 albums called Ethiopiques, Queus, covering all the major artists of this Ethiopian jazz. And it's really unique because it's built around this traditional Ethiopian music, which is a very African, Muslim-y kind of thing, but with a jazz overlay on it. So really, really interesting.
Okay.
Anyway, that's been my week.
Oh, thank you. I'll check that out. Hey, have you had one last thing before I go? Have you heard of Ignacia Fernandez?
Oh.
Google her. She was I think I'm going to say Brazilian Miss Universe winner. And I think she may have placed highly in the international pageant. But she's also a death metal singer. And for her...
Oh, I have seen
yeah,
that.
It's great, isn't it?
I saw the clip this week, yeah.
Yeah, so it's this supermodel doing death metal. It's fantastic. Yeah,
I did see that. It was hilarious. Yeah, good for her.
Yeah.
I don't like her chances of being able to speak a year from now, but... All right, well, this week on the US show, we're doing another power company, but Korean this time. And there is an assassination that I get to talk about. It's not as bloodthirsty as last week's episode. It's not as... This company has not been found guilty of manslaughter, but there is some good backstory to it. So let's go talk about Pepco on the US show.
Thanks, Cam.
Thank you, TK. Right. Have a good week, everyone.
Bye.